Woo. Okay, so we are now live online. All right, so let's get everything together and start talking about. Hello, Al. Okay, so I'm not sure. We are streaming on Zoom and we are streaming on Facebook, my group at the same time. Got one of each people. Okay, so let me know, Al, if you can see my screen okay. I'm assuming you should be able to, just due to the fact that I have my screen showing on the Facebook stream. All right, so let's get down to the brass tasks of stuff. Alrighty, how many have watched my video I put up on my channel a few days ago? I put it into my email regarding, let me just pull up my channel here, Quant Labs, and let me show you what I'm talking about. So if you go to my YouTube at youtube.com, you go under the, do a search on Backtest. The particular video I am referring to is one called Backtest. I put up 4 days ago. Backtest result trend is not your friend, but these are the next steps. So I'm going to showcase the repeat of this, and I'll show you what we've got. All right, so I've been testing a strategy using Dukas copy. First, it was originally for Forex, and then I expanded it into what I call commodities and stock indices. I've got a variety of videos of that on my YouTube channel, and I would not going to be going into great detail with that here. Just give me a second while I pull up some spreadsheets for you. Now, all this is done in Python. The data comes from the JForex Dukas copy or Dukas copy JForex platform. Again, I've got videos that will show you how to grab that data. So I'm not going to get into it here. And let me just show you what I've built. So, as I said, I've got everything divided up into 3 categories. I've got an equity section and a commodity asset class section. And these are pretty well the same. I'm only going to focus on Forex for now. But I will say, based upon my performance, let me just pull up my spreadsheets here. Okay, I'm going to show you the indicators I'm using. I've been putting a lot of reliance on trend. So I'm doing regression. Okay, thanks, Al. So hopefully I've been putting a lot of emphasis on trend, and that was the back test was focusing on that. So let me just pull up my spreadsheet stuff. I'm going to show you some of the indicators that I used. Okay, here we go. So I've got spreadsheets. I was using moving average. I was using trend. Let me just show you that spreadsheet now. You're not going to see Excel. You'll see LibreOffice. And I've got 35 pairs as part of this analysis. I can expand it to, I think it's 60, but right now I'm using a demo account for my testing. And with that, as I said, I've got access to 35 accounts, 35 pairs, up to 60 pairs once I get the account live. And a lot of them are exotic pairs. So these are the pairs that I have right now. And what I do is I've got 3 indicators. Now, I divvied up the charting based upon 4-hour, daily, and hourly. I've been testing for many months with the intraday. It just does not work properly. I mean, you could do intraday trading within JForex, no problem, but I do find it's a tough gig. Whereas you have more losses than what it's worth. Okay, so here's some of the indicators that I'm using. I'm using regression, so I'm measuring slope is the big one. And part of that, I can also capture the R squared. So obviously, the steeper the slope, the more momentum, I guess you could say, behind that pair. And I'm also measuring the strength of momentum through R squared. So it's not difficult math. There's different ways to calculate the linear regression. I'm just using one from, I believe it's pi. I believe it's pi org. There's 3 different ways. There's one from pandas, numpy, and it's standard, simple linear regression I'm using from one of those packages. So it is to be relied on, supposedly. There's also one linear regression indicator you can use from Dukas copy itself, but I was not too confident with that one. That's all done in Java. I did not have a lot of success with that one. So what I usually do is I'll go through each pair and basically do an analysis or do a linear regression, as I said, for hourly, 4 hourly, and slope. Intraday I did not have a lot of success with, just due to the fact that it didn't matter if I shorted long, it just usually went negative. And I think there's a different way to analyze data or to run a strategy on whatever asset class it is. So in my case, when I was running all the different types of analysis on the intraday, I would accidentally leave JForex running through the night, and then I would see it. Oh, we got more people. Welcome all. I would notice that if I left JForex running with Dukas copy, what would happen is by accident, I'd get higher profit on the returns. And it was weird because you would think you'd be able to get better profit opportunity on trading on a minute time frame. But then when I started running it more and more, I started realizing I'm getting more profit potential by letting it run through the night, letting it run for a couple of days. And what I found was all my best trades were running at least through the night, and they would be running for at least 8 to 10 hours through the night. Then I would let it run for another 4 hours or even another 24 hours. And I was getting crazy returns, like a magnitude of 5 times. I mean, what I was getting was unreal. Whereas if I let the strategy run on an intraday level on minute data, there were a lot of losses, and that then became where I was dependent upon that big monster trade to sort of offset all of the negative ones. So I started focusing more on the hourly, 4 hour, and daily data. And I started realizing there's more opportunity by smoothing out the data and removing all of those, which was a lot of negative positions on a on a minute basis. So I got rid of that, and what I started finding was some patterns, specifically around slope and R squared. And I was using some other indicators, which let me pull up those. Okay, so I started looking at classic technical analysis indicators. Other big one I started looking at was Fibonacci retracement. And there's 2 purposes I find that are really good for Fibonacci retracement. Is at the current time that you're running the Fibonacci analysis, and you look at, depending upon the historical or the time frame, you can easily figure out the value of the current price against the historical data set that you're running. So for instance, if you know, let's say if you ran an analysis on the S&P 500 over the last, let's say 6 months, and you did a Fibonacci retracement, you will find that the current price of the S&P 500 is going to be overpriced. You obviously you don't want to trade like that where you're buying high and maybe selling low. That's not the way to trade. So the Fibonacci is really good for that, to time your trades and to figure out, no different than RSI, on the value of the trade opportunity on the entry, and you can measure that historically how far back you want to go. If it's hourly, 4-hour, or daily, you can do that. So Fibonacci is good for that. And the other thing that Fibonacci I really like is where if you want to put on a position right now, you can set the retracement levels on the Fibonacci levels. So if you're going up one level high from the current price, you're able to gauge a target price. So if you go up to level, I can't remember the levels of 2 and 3, I can show you a chart of that. Let me just show you a simple chart. So this is one of the charts that the system will bring up. So let me show you one of these charts for the Fibonacci on a daily. So what I'm talking about is we have here the current price all the way back to just before December of 2016. So you can see here the US dollar and the South African rand. If you were to buy at this point, you want to get into the trade in this, where the box is here, in these two levels right here. But because it's below here, this could be a good opportunity because it's undervalued. But usually where it's getting killed at that value, if you look at my spreadsheet here, you'll notice for that you most likely have negative trend, and that's what you have. So that's probably why it's undervalued. It's obviously people are not paying attention to it. There's not a lot of value there because there's just negative trend, and it's been negative probably for the last year or so. So that's a really good indicator as well. And another indicator that I used was, let me just show you here. I got a signaling indicator as well, and this is really good too. And again, this is the underscore D is daily, 4-hour, or hourly. If I know at a certain time period that there's too many sell signals, why would I want to put money into that trade? Because obviously there's going to be more selling momentum on that asset or instrument. So it's a waste of money to deploy capital into that, because if that selling signal continues, it's going to continue to go down. So that's another indicator I used. I talked about the trends. Got two types of trends here. These are supposed to run as a combination of support and resistance, being the red and the green. Again, this is a daily chart going back to probably just over a year, 500 data points here. And again, you can see it just overall, it's a negative trend. So when you start looking at the overall trend here, you start to see negative. But if you start to focus on the ones that are positive, so if I do an overall sort here for these currencies, just give me a second here. You know, this is simple brain dead stuff, but I kind of found it was an important lesson to be learned. So if I do a sort on H being slope D, descending, what you'll find here are the currency pairs with a stronger trend on the daily data versus intraday data of the 4-hour or the hourly. Here you can see we have a fairly strong trend on this pair, which is the Euro Hong Kong dollar. Then we have the Euro Swedish krone, and then the British pound, the Canadian, and so on and so forth, based upon how you sort this. And I decided to run a back test against all of these indicators, and the overall consensus that I came away with is, let me just go to my command prompt here. Okay, so in here, like I said, everything's done in Python. And what I decided to do is I'm able to, from JForex, the Dukas Copy platform, lesson be learned is when you're testing and you have a selected broker, you always want to use the market data from that broker, because if you use data from another source and then you price based upon that data from that source in a different broker, you'll find that your pricing can be off a lot. So you want to make sure that you're using the same data source for your market data as well as where you're going to put your orders in as well. So with that in mind, what I did was I built this overall backtest. And let me just run it here. Yeah, right here. Okay, so I'm just so everybody knows, I've converted everything into Python 3. So what this thing does, I'll just let it run for a couple of things, a couple of instances. Okay, so what it's doing is it's downloading. Now, as I said, I can run this back test against any asset class I want, be it commodity or be it equity like indices and Forex. So tonight I'm focusing on Forex only. So Ninja Trader's got a question. Would you make more sense to limit the data to significant digits? I don't think it really makes a difference if I rounded it up or not, to be honest. The idea here was just to get the general rough idea of how my stock picks were correct or not. And that's what I want to show to you tonight is you can't really rely on back testing. And I'm going to show you why. So what I did was, you can see here that this period is for January 19th, 2005, and that's on all available major currency pairs. So then what I did was I would download all the data I had access to for that time period. And then what I would do is I'd run all that data through. Now I'm just going to get into for Ninja Trader. I'm about to get into the forward testing. So what I did was, to answer his question, is we run this for 90 days. Okay, so I'm getting 90 days worth of data from that time period, starting 2005, January 19th. Then what I do is that I run that data set, which is for 90 days, and then I run all my analysis and let all the indicators that I told you to gauge a overall, what would be the best overall currency pairs to pick for the next week, 2 weeks, or 4 weeks. That's what I did. So what I did was I ran the analysis against, from that time, 90 days after January 19th. So then I would pretend to say, okay, here's the currency pairs I think that my system or my strategy will think have the strongest trend, and among other indicators, and then it picked, these are the strongest, highest probability that they will do well on those picks for that day. So what would happen is, well, hang on here for a second. I just got my, okay, back to business. So what I would do is I would run an analysis, as I said, on a 7-day period of actual data after the 90 days starting January 19th, 2005. So I'd let the system sort of like pick, here are the highest probability of these top 3 currency pairs. And I ran that analysis of actual data after 7 days, 14 days, and 30 days. This is my whole point, is that here's the pairs that it picked: Euro, Japanese yen, US dollar, Mexican peso, and the Japanese yen, okay? So these are all the indicators that I choose: the moving average crosses, the number of positive returns for that time period, and the R value and the slope, okay? So what would do is it picked those 3 that would think that are the best, has the highest probability of getting a decent return. But this is the actual data that I get back after 7 days of a percent move, as well as a 7-day, a 14-day, and a 30-day. So in this case, if I did put actual real life money on 90 days after January 19th, and I did put capital on this pair and waited it out for that position to get closed after 7 days, I would have lost 1.26%. If I put money on the U.S. Mexican peso, I would have lost 0.13%, and I would have lost 2.8% on the U.S. Japanese yen. And these are the percent moves that I would have lost if I held on for 30 days or 14 days. Okay, so when you run this for the whole time period, I'm going to let it run in the background. Let me just show something else here. There's a text file here that I have that I'll load up here, and I'm going to let this thing run in the background. Okay, so let me just go back to my terminal here. So I'm going to let that guy run in the background. So what I did was, this is really interesting. I'm going to let this whole process run. Here. So what it does, it will run every 90 days up until the most recent time, which will take us to, I believe it's November 2017. That's as far back I can go, and also the most current. So it takes a little bit of time for this puppy to run. So right now on 2009, it takes like a couple of minutes to run. But the idea here is I want to show you the likelihood of this back test to give you a positive or a negative result on actual data. So I'm just going to let it complete. It'll take me up to last year at some point, I believe in October, November. And then I'll show you the overall results of this. But the point to this is that you cannot rely on something like trend. And there's other things I'm using like moving averages and whatnot. So the idea is I want to show you the result, and then I just wanted to get some kind of dialogue running to sort of like what can be learned from this and what can be done about it. And I have some ideas on it. Okay, so it's now finished. So let me go back to that file I want to show you. Okay, so these are now the percent moves overall, positive or negative of actual data. So these are the positive moves out of the entire 35 currencies. Only 34% moved positive, were profitable on 7 days. 31% were profitable on a 14-day move, and 31% were profitable after 30 days. So when you start to look at these ratios, just focusing, let's just say on 7 day, you can see how low the probability of having winning trades are of actual data on this back test. So the highest you may get is 70%. But here's where the problem is. When you're starting to get only 40% of those 35 currency pairs are profitable on a 7-day move, or 28%, or 37%, 50%, and so on and so forth, and it's so unpredictable. One of the big things to take away from this is when it comes to Forex data, it's very random, and there's really no patterns that you can decipher from this. And again, this is actual data from Duca's copy. So Ninja's trading, without expectancy, you will not get far. You have to define what you mean expectancy. If you want to unmute yourself, by all means you can do that. But the whole point here is that we have a very low probability of having profitable weeks, let's say on a 7-day move of actual data. So the point is that even though I hinted at all these different indicators that I'm using, what I found is that markets are too random. Now, there's a lot of ways that a lot of retail traders get fooled. If they're only going to trade on Forex, they're going to lever up their leverage, basically, to get the higher returns. I've also done an analysis on the different types of asset classes. So all I can tell you is you get very low percent moves in Forex, and that's without leverage. But when you start to look at other commodities, we'll call them commodities, That can include treasury, gold, oil, silver, Bitcoin, and what would the other one be? I think that would be it. What I found was you get maybe double the returns here. So you get maybe instead of a 2 or 3% move for the week, you may get a 5% or a 6% move. But again, at the end of the day, when you look at the data and you look at how random the markets are, it's very tough to get winning trades on a weekly or a 30-day move of having a in this case, we have out of 35 pairs, only 28% are profitable, which is, again, random. And from what I've talked to other traders, they say the same thing. It's because the market's going in this random walk. So this notion of backtesting is very difficult to absorb because even though I have all these indicators at my disposal, what I'm finding that's not the right way to trade. I've put up another video to simulate how some of the professional traders do it. So let me just show you here another video I put up on late Thursday night. And there's some people out there that I've been watching with the hang on here. Okay, let me just show you something here. So in there, I put up this analysis, this video right here. It's I believe 2 hours. And what I've done was I ran it as if I was a human trader looking for different patterns. As Ninja Trader says, he says, percentage of winners is not the main issue. I don't know if I'm correct in saying this, if he agrees with me on this or not, or she agrees with me on this. It's not about the percentage of winners. What it really comes down to is the timing of those trades. Because if you've watched some of my other videos, and let's say in the last couple of weeks, I've got this portfolio optimizer. So let's say you're flushing cash and you're going to deploy, I don't know, $1,000 a day into the markets. So if you're going to put $1,000 into the markets a day, obviously you want to put into the positions and instruments that will give you the highest rate of return or the highest expected rate of return. And that's obviously what you're after. Well, guess what? That's what this does. It's using historical data of multiple time frames to base on not only expected rate of return, but expected Sharpe ratio as well. And these are the outcomes. So the end result is what I've shown you. It's just this unpredictable nature of predictability on getting, quote unquote, profitable trades. Now, you're saying expectancy is the main issue. Okay, that can be defined in a lot of ways. Like I said, if you want to unmute yourself here, I'm going to look up that term, expectancy, just to make sure we are on the same page here. Okay. So, state of thinking or hoping something pleasant will happen to be the case. Yeah, you're right. But that's not what we're after. At the end of the day, I'm not hoping for a profitable trade or whatnot. What I'm testing for is the methodology working? And it obviously doesn't. So obviously there's going to be a better way to do this process, but I think it can be applied to a lot of strategies. And I'm sorry. Yeah, hang on, man. Give me a second here. Yeah, it's good that we get this dialogue going because this is the whole point. I'm sorry about that. You should. Okay, go ahead, Mr. Ninja Trader. Oh, no, unmute. Okay. Okay. You're unmuted.
Okay.
Okay, go ahead. Go ahead. Yeah, go ahead.
You can hear me now, right?
Yeah.
Okay. So basically, expectancy. Okay. Let me just very shortly, I'll tell you, I'm an unsuccessful trader.
Yeah,
Okay?
we all are.
So I don't want you to think that I'm some kind of genius who makes oodles of money.
Yeah,
But
we understand that.
I have written, I would say, a little over 900 scripts using a program which was called Wealth Lab.
Yeah, I know of it.
And out of those, 2 made money over a very long period of time, but a very small amount. And you needed about $5 million not to lose your shirt because of drawdowns.
Right.
So expectancy, basically, it's a small formula, which is the number of winners multiplied by the by the percentage of winners,
Yeah.
minus the number of losers multiplied by the percentage of the loss. So if you win 9 times $1,
Yeah.
and you lose 1 times $11, basically your expectancy is -2. So on every trade, on average, you're going to lose $2.
Right.
Now, a positive expectancy is obviously a number which is greater than 0. So you can have, let's say, 40% of the time, you're going to make $1.
Okay.
And 60% of the time, you're going to lose 50 cents.
Yeah.
So now 40 times 1, so that's, let's say, $4, and you're going to lose $3 because of the losses. So your expectancy now is $1, which means on average, over a long period of time, many trades, you're going to make $1 per trade.
Okay.
Which is neat because at least you know that even if we hit a streak of, I don't know, 2, 3, 4, 10, 15 losses,
yeah,
on the long run, you're going to make money.
Okay.
And I've done like what you're doing with these formulas, to my mind, and I don't mean to poo-poo anybody because you spend a lot of time on this. You seem to be doing what is an curved fitting.
Yeah.
And curve fitting obviously doesn't work.
Yeah.
Right? You may work, it may work for a short time, but after that it stops. And what you did, running it for 90 days and then running it for 57, 14, and 30 days, that's probably the proper way. I've never found the proper way to do this.
Yeah, yeah. So I mean, okay, what right now from your testing with the expectancy, what you're telling me is you've written 900 scripts and nothing has really proven to be consistent over.
No. And I've done this since 2004 up until, I'm ashamed to say that, but
okay.
I would say I stopped about 3 years ago.
Okay.
And what I'm doing for the past 3 years, I'm trading live. I'm trading only the IWM and the triple Q.
Okay.
And it's not automated. I'm trying to automate it so far unsuccessfully.
So go ahead.
And this is just basically based on a pattern, on a visual pattern.
Yeah.
And visual patterns are very difficult to program, or at least you're a programmer, I'm not, so I'm struggling.
Well, what I've not mentioned, though, is I have, let's see, 8 identifiable patterns. Again, I'm using only technical analysis. 8 patterns there, plus there's another set of flag and pennants and another set for wedges. And as you said, they're very difficult to program. So I've got them in custom development by somebody, and the hint I can give you is if you go on to Metatrader for either MQL4 or 5, specifically obviously for Forex, and you look for those patterns for whatever you want, you will find indicators that have source code available in MQL4 or 5, and be able then to look at that and determine mathematically how it's done, which is not too difficult, and then be able to translate them into charts. But what I'm doing is I'm getting them custom coded by somebody else, and then get them converted over into Python. So apparently it can be done. It's just you got to find good sources. So as a hint for anybody, is just go to those sites, the Metatrader, MQL 4 or 5, and just look for whatever patterns you want. You'll find them. They're there. And there are lots of coding examples that you can use for that. Do they work? I can't say. But I am finding that there are a couple of sources that look good. And I've had some people that are experienced in Metatrader, and both Metatrader as well as back into Python. And they said, yeah, it can be done. So for me, I find the communities for both, well, just Metatrader overall has got the best sources, a place to look for code, because it's so big and so popular. And a lot of those indicators are probably not the best, but there are going to be indicators on there, or the, what they call them, the EAs, expert advisors or advisors. They have some of the best code examples on there of any platform that I've seen. So
I agree with you about that. But may I ask you two questions?
Yeah, go ahead.
Is any of the automated trading that you have conceived in the past made you money? For a longer period of time?
No, that's the thing. It's temporary, because what you find is you get temporary pops that you can easily predict, human or not.
Okay, I appreciate your honesty and candor.
Yeah.
Okay, I think that the secret, unless you do high frequency trading, which I don't think you have the computing power, I definitely don't have, and we are not going to collocate to Chicago, right?
Yeah.
So the only thing that will work is something which has been constant in trading over the past few centuries, and that is human greed.
Yeah.
And if a trading system could be designed around that, then it will be successful.
I mean, I'm sure you could probably talk to some of the AI experts, and they'll probably say, "Oh, that's already done," or machine learning, it's already done. But yeah, I think you're right. Where to get consistent profitability from a systematic point of view, it's not. I won't say it's impossible. I just think it's a challenge to be able to get an actual system that can do it consistently all the time. So that's my whole point. But I do think you can get a system that will I won't say consistently profit, but what asset classes? You said QQQ. What was the other one?
IWM, which is an ETF of the Russell 2000, and Triple Q, which is the ETF of the Nasdaq.
Okay. Yeah, those I would imagine are quite predictable. The thing is, when you're dealing with more, let's say Bitcoin or Forex, where you're trading off of really sentiment and news and events that can shock or impact those instruments, right? So let's say a few days ago, there's this exchange, Polynex or whatever, they say they're withdrawing all the options of 80 altcoins. So obviously that's bad news. That's going to kill off the performance of those instruments. Or another example with Bitcoin, where I think it was Mark Carney said, no, we're not going to do any regulation on Bitcoin. And then obviously that's when the algos go crazy, and then they start to move Bitcoin up, and it went up like $1,000 or something in the last 24 hours. So yeah, you can trade around that. The problem is that it's not predictable. Is there some sort of seasonality you can get out of it? Yeah, there is. But I do think that there is a way to systematically be able to trade. Okay, so there's I'll put it in the chat box. Her name's Nick Trades. I've been following her for a couple of months now. She focuses on cryptocurrencies. And what she does is she shows you, that's why I'm doing the technical analysis now, because it seems to kind of be more predictable than quantitative or machine learning methodologies. And what she does is she'll basically use very simple indicators and percentage of moves to be able to say, I'm not yet today interested in going in and entering into this particular instrument. But what she'll do is she'll set targets, and that's where the Fibonacci retracement comes in. So knowing all these rules and sort of rules-based type of, as I said, methodologies, combined, I think there is a way to build a system around that. And I'm not sure, as a human, obviously, you have a very limited number of assets that you can watch. So let's say in your case, you're able to watch two instruments in the equity space that there's some form of predictability or some kind of pattern that's predictable. But from a systematic point of view, I've shown you 35 currency pairs that I'm able to kind of watch. But if I'm able to build a set of rules on how a trader thinks using all these simple technical analysis, I think there's a way to do it. I'm not saying there is or there isn't, but I think there is.
So Brian, what's the purpose of your group?
Oh, my group evolves. This tonight is just reintroducing these weekly webinars that I'm doing over the next, who knows. I've done these in the past. I've had 30, 40 people come out for these. And the idea is to showcase what I'm working on and then to do exactly what we're doing. Talking about it, learning about it. I can take away from somebody like yourself and take whatever methodologies I can learn from what you're telling me, and then figure out a way to re-implement it into another strategy or tweak it based upon what I'm learning from it, and then down the line showcase it and have people as a group learn how to do this. That's the whole point of these.
Okay, I hope you agree with me that that since we spoke about it a few minutes ago, if you and I and people like us don't have the computing power that huge corporations have, even though we make very fast computers, I'm certain that the corporations already exhausted all the possible combinations and permutations of indicators. You know, any combination, MACD with all its numbers, RSI, whatever you want, CCI, all of them.
Yeah.
And if they found something that works, they're not going to publish it.
No, I agree with that, 100%.
But I suspect that they haven't found anything because, you know, just a small anecdote. My first computer, which was running Metastock 1, if you know what Metastock is.
Yeah, I know Metastock, yeah.
And by that you can figure how old I am.
Yeah.
So, I was running on a 386.
Yeah, you go way back.
About I would say 17 to 18 hours one pass. I mean one optimization of one equation.
Yeah.
And then after a few years, when we got to the 586, it would run it, let's say, in 15 minutes.
Right.
And what I have now probably will do it in 5 seconds.
Yeah.
Okay. And I got nowhere. I got absolutely nowhere. And I'm sure that these other companies are getting nowhere also. The only I spoke once, I was in a group, and one of the guys was in charge of 2 quants, and they were for high net worth clients.
Yeah.
They were developing trading systems. Basically what he told me, and this I will never forget, he said that all the system that they developed ceased working after 3 months.
Yeah.
And less than half did actually make some money for a very short time.
Yeah.
So that means whatever you're going to do today, you're lucky if it will work for 3 months, and then you'll have to devise a new one.
That's right.
But you see, unfortunately, we don't have infinite life, so you cannot do this forever because you need to make some money also.
Sure. Lee, there's different ways to respond to it. When you say hardware power, obviously there's cloud computing as an example. There's lots of, let's say you want to just focus on Monte Carlo or some kind of simulation of high-end testing. There's a lot of cloud solution providers that give you access to CUDA boards. So if that's the case, then as long as you're willing to pay for it for an hour, 2-hour test, you have that power. In terms of have they exhausted whatever indicators, it depends. I don't know who your broker is, but let's say if you're talking Duca's copy in my case, because with the brokers, Duca's copy literally is its own pool of traders. So if you took what you just said with the same logic with Duca's copy, yeah, you're probably right. But I can probably bet you with all of the clients of Duca's copy exhausted all potential possibilities as an indicator or whatever indicators you use. The only time Duca's copy would probably step outside of their network of pool of trading or trading pool is when they got to step into a prime broker and do market making. But they don't do that. They're an ECN. So they must be big enough to be able to handle all kinds of, as you say, permutations of different combinations, because you're not stepping outside of that network. And even if you were just to say, okay, let's say you took the global view of currency trading or Forex trading, you got to remember that's a $4 trillion a day business. So even from a retail perspective, you'd be capturing a very small percentage of that. And then that's just Forex. And it's a big market. And I also think when you factor in all the banks, the hedge funds, all the algorithms out there, institutional or not, I bet you 99% of them are unprofitable. So I personally think there's probably going to be a lot of opportunity out there with the efficiency and inefficiency debate. That's something different. But I don't know. Maybe I'm like to be hopeful, but I think there's always going to be some form of an opportunity out there. Because there are going to be a group of people that are profiting off of this, systematically or not. And there was another thing you mentioned. Yeah, I should be writing all this down. But, I mean, overall, I think that there is an opportunity. And I remember the other thing I was looking at was if you took all the banks, human or not, systematic, I think where we fail ourselves as retail traders trying to be wannabe HFT guys or quants or whatever, I think where we fail is I put out lots of polls. And I ask the simple question, if you could look at the markets either as a trader, as a computer scientist, or a mathematician, which one would you choose? Most people will probably choose either computer science or mathematics to look at the markets. And that's a very limited view of the markets, because I guarantee you traders that have been doing this for a long time are winning at it because it's how they view the market. So if we had the ability, I'm a computer science guy, and that's how I think, but I'm trying to transition to see how profitable traders make money. And they're doing it as a human. So that's the point, is trying to mimic the behavior of a real trader, a real profitable trader, a real trader that's institutional. And what I found is when you look at that one I was mentioning, Nick Trades, I just put in the chat, she's doing it, and she's been doing it for 6 years. And the funny thing is, when you look at that analysis that she's using, I was watching Bloomberg the next day, and there are 2 other traders mentioning the exact same indicators and the exact same. And I really feel that her methodology is kind of universal on an institutional level, on what a lot of quote-unquote human traders are doing to be able to make themselves profitable day in, day out. Because we look at only 2 or 3 instruments, but what she does, she just quickly looks at a chart and looks at the timing of it. And if it doesn't look right, she moves on to the next chart. And that's what she's doing as a human. But imagine taking that skill and being able to automate it. You can probably take all that time she's putting into it as a human and being able to whittle it down to probably a few minutes. And that's what I'm trying to do now. And that's why I got out of the intraday type of trading or analysis, because I was not able to make money at it. But once I started looking at it from this point of view, I was like, whoa, this is different. And I think that's my whole point of backtesting and the whole methodology that we're supposed to do it, like on Quantopian or one of the other bigger platforms or educational places. This is how we're supposed to do it. And I think, no, I don't think so. Because the back testing clearly shows that there's randomization going against you, and a lot of other things that we don't have control over, like market making or all kinds of things.
Sorry. What you mentioned that you actually, I see from your Excel sheet that you're going through a lot of instruments. If you look at any profession in the world, there is specialization. You go to a doctor, there are doctors for everything. Right? You go to in the construction business, there is no one person who can do everything. You won't find a plumber who can frame a house and do the electrical work.
That's right.
Right? In a car mechanic, there are people who deal with the electrical system, some with suspension, some with other stuff. So why not choose one instrument and study it and exhaust it? You will have much more chance of success if you concentrate on the one instrument than if you try to do everything on all of them.
I agree with that. Because when I started this whole thing at a real deep level, looking at these different currencies, what I found was the regime, the performance, all from a Forex perspective, all the high-end returns were in the Japanese yen. And now it's, say, the euro. So the market changes where the profit opportunity is. So to say you're going to watch the flow of a particular instrument will work, but for a period of time. But you got to also, from a higher level, know where I watch and read the Bloomberg News app every day. And what I find is if you want to do well overall consistently, you have to follow where the hot money is going, hot capital. So for instance, if it's just purely currencies, there's going to be a specific currency that will do well for a period of time. And that's where the hot capital is going to go. So as long as you know where that hot capital is going to go, you'll get that trend for profit for a period of time. And then it's going to go somewhere else. So in our case, for the last 9 years, it's been in the equities, right? U.S. equity, most likely in, FANG stocks, Facebook. Okay, so let's say the FANG stock. So all of that's starting to sputter out now. So that capital, where all that profit was, has got to be somewhere out there that's going to be somewhere else, because the institutions have got a duty to get yield no matter what. They have an obligation to all the pension funds to get a return on their portfolio. That's what they're being paid for. And that's why they exist. So as long as you understand that that's the mandate these banks and hedge funds have, that they got to invest somewhere. So as long as you know where that hot flow, that hot capital is going, you can follow it, even on an institutional or on a retail level. And that's what I'm trying to do now. And when I ran all of this analysis thinking, there's going to be some money or returns that can be made in Forex, I thought, if you want to see a 0.1% or 0.5% move on something, there is some yield there. But that's why I started breaking it out into, it sounds like you're in Europe, but obviously it's CFDs, let's say. That's what also Dukas Copy focus on. And
I'm in Toronto, by the way. I'm not.
Okay. Oh, okay, I got you. But if you look at,
I can almost see you talk now.
Oh yeah.
Thanks. But you know what? The funny thing is, if you look at Forex, Forex is the worst possible instrument for an individual trader to use. The spreads percentage-wise are huge. Some of them tell you that there is no commission, but it's not true, right? If you take futures, which has a fairly high leverage, not as high as Forex, but fairly high leverage. You can make money there. Some people I know make, not too many. I know actually only 3 people who make money.
Yeah.
In the past, I would say 11 to 12 years, I met only 3 people who made money.
Yeah.
So the reason people move into Forex is because they hear these wonderful stories and they see the ads that show you 95% accuracy, which is BS, because again, it's expectancy, which is the important one, not how many times do you win. The entry level is very low. You're putting $1,000 as a bet, and if you lose it, no big deal. You go back to your job.
Yeah.
But if you want to trade futures, you have to put a little more. Not much more, maybe $500 as a margin per instrument, day margin, not overnight margin. And if you want to do what I do, then you have to put in probably about $35,000 US. And I don't think too many people are willing to take the risk.
Right.
So usually the money is where the risk is.
Yeah.
Whereas where the entry bar is low,
yeah,
then the possibility of making the chance for that is also low.
Right.
So you see, people spend an enormous amount of time, and I did also, on Forex, when I used to play with Metatrader 4. It simply did not work. Or there is another possibility, is that I'm not smart enough. That's always a possibility.
Yeah.
Right?
Yeah.
I don't have an MBA. My math skill are...
You're just like us, like the regular Joe.
It's us. I'm not... Okay, it's embarrassing when you say us because that excludes me. I'm part of the group.
Yeah, that's what I'm saying.
I'm not successful, okay?
A lot of us are not successful.
On my IWM and triple Q trades, I don't know. Obviously, I cannot make a living on that. I'm doing that because I'm having fun. So whether I lose, I don't care.
The thing I can take away from what I'm doing right now, like looking at all this, I can still use what I'm building as a way to use these as tools to be a human trader, because I'm not basing it upon hunches. I've actually got real data to work with and be able to look at trends or patterns or whatnot and be able to get trading signals that my system will pump out there and be able to do that that a lot of humans won't be able to do, because they don't work off of data. And there's that big saying that says the numbers don't lie. And there's a lot of things that I'm able to see that you will not hear on CNBC or any of the news networks or even reading on any of the forums. And that's the advantage of using this. The thing, though, is to be able to automate it where you can use it for orders or execution. That's a tough game. But I do know I got over, I don't know, let's just say thousands of people in my groups, and there's quite a lot of them that make very good money at this. I'm just taking it from the schmuck's point of view, not like from the training of a hedge fund guy or some kind of big wig at a bank. I'm just trying to prove that the little guy can kind of do this. You know what I mean?
So the people in your group that you just mentioned who actually make good money,
yeah,
what are they doing?
Well,
are they day traders? Are they traders?
Yeah, I've got a variety of people. I've got one guy who's retired from a hedge fund. He's a multi-millionaire, and he's built the whole his whole company off of simple Python scripts, and that the whole company's built on that, and he's been doing it consistently for quite a long time. I've got other guys that coming out of banks. I've got one guy who's head of the machine learning department of one of the big HFT firms. So I've got people that are watching what I'm doing. I'm constantly in contact with other people that do this for a living, as I said, as the institutional and at the retail level. But what I'm trying to do is to break out and be the little guy, the retail guy, starting with nothing, to be able to show you don't need to be a mathematician. You don't need to be a computer scientist. You just got to have the tenacity to be able to work at this and keep grinding away to find something. And when you say what you said, you said 900 scripts that you wrote, and only 2 were consistently kind of profitable for a period.
No, not consistently. 2 of them made money with huge drawdowns. That's not consistently.
See, that's maybe part of the issue. Is I'm not going to say, come out trying to criticize you, but what I do find talking to other traders is a lot of traders are not building, focusing on portfolio. They're not looking at what the market data says. It says, oh, there's going to be a potential drawdown here, lower your risk. A lot of people don't look at the full enchilada of how to properly trade, because a lot of people will focus on a strategy or they'll focus on an algorithm, and that's it. And it'll work it has a shelf life, but they're not looking at the entire market and what the market's saying. And that's what I was talking about on that hot capital flow, because it's so important to really fully understand these type of how the markets move and where they move to. And that's important to understand that. And that takes literally who knows how long to get. But when you're stuck in a certain mode of thinking, you get caught in a trap. And usually talking to a lot of people never come out of that trap, right? So call me different, but I'm only different because I'm learning from a lot of people. Let's just leave it at that. And I get to see different viewpoints. And then I just take the little pieces out of that and be able to build an entire system, not just on algorithms, but also, allocation in terms of position sizing and da-da-da. It's a lot bigger process than just building an algorithm, and an algorithm that will have a shelf life. And being able to understand the risk profile when you put on a position or strategy, so on and so forth. And a lot of people don't really get caught, don't view that. And I don't know, but I can just say, especially from a retail trading perspective, that's why a lot of retail traders don't do all that well, because they don't view the market that way. It's just all about some strategy, and then they run it, and it works well for a couple of months or maybe a year or whatever, and then it dies. But yet that strategy is still valid. It's just the market timing is not good for that strategy. But if you have a suite of strategies, let's say 5-10 strategies, you can do okay, but you'd have to deploy another strategy because the regime of the market's changed, or whatever you're watching, the market regime changes. So if you have
those people,
go ahead.
People that you say that they're in your group and they are consistently profitable over many, many years.
Yeah.
Obviously, since you're talking to us, those people did not tell you what they're doing exactly. Otherwise, you would not be, right?
Well, no, that's incorrect. I've had people, as I said, show me. I'll leave it at this. Most people that are profitable, and it's a consistent thing I'm seeing between the institutional guys and the retail guys. How much time do you think you should be focusing on your portfolio versus how much time you should be focusing on, we'll just call it price action? Like, how much time do you think you should be focusing on your portfolio? And people say, 10%. No. Most profitable traders that do this as a career, 80% of their time is spent on portfolio analysis, because they're not chasing yield. That's not how they do it. They predict where the markets are going to be in a year, in 3 months, and they set up positions on instruments that are low value. I just showed you, I don't know if you saw it, but the US dollar and the South African rand, they may see something that we don't, or they may know something that we don't. They may put on capital for that position while the value of it's low. Then as things start to heat up, call it, using forward-looking data, they're able to then get out of the trade 3 months down the line when the retail market's starting. This is a good opportunity to get in. The professionals are using that liquidity to get out, to exit their trade. That's why it's called dumb money, because they're kind of chasing after profit that's kind of like there, but they're typically buying high, selling low. But the institutional guys don't look at it that way. They're seeing something 3 months out, And they're always using forward-looking data, and it's usually fundamental data. And a lot of retail traders don't do that. And consistently, that's the pattern I'm seeing. Consistently, through and throughout, all the institutional guys. And the retail guys that do well are doing the same thing. And it's always about forward-looking data, looking for guidance, looking for forward-looking indicators that show this is where this instrument will be in 3 months' time. And I always see retail traders argue that, always. And they're the ones that get killed. And I never talk to them again after 6 months because they've been killed. And they don't see the markets that way. And I don't know. But the consistent guys, the institutional guys, are the ones that are using that methodology, always using forward-looking data and seeing where that particular instrument will be 90 days. And when I say that these guys are focusing 80% of their time on their portfolio, what they're looking at are things that we don't look at: Federal Reserve or central bank information, macroeconomic data. They're able to use that data to their advantage to figure out where the opportunities lie in 30 to 90 days. And that's how they do it. And where they get where they're making their most profit is in options. And they buy low, and the classic buy low, sell high. And as the retail market sees that, they're getting out. And the retail guys may get 5% moves, but these guys, the institutional guys, are getting 30% moves over a month, 2 months. And these are the human guys, let alone the HFT guys. I mean, that's a different ballgame, as you said, right? And that's, unless you have a large account, we can't do HFT trading. But the retail, the institutional guys, that's how they do it. Is they look at forward-looking data, know what's going on 90 days out, and they put on those trades early, and they exit as the retail guys pick up on it. And that's usually the CNBC crowd, right? So
I look at CNBC as an entertainment show, so I wouldn't consider them.
Yeah, I know. It's just, I don't know.
You see one guy, and 5 minutes later you see another guy with an opposing thought.
Yeah, so, now all they're doing is just yelling at each other. When I was watching a guy that's been on that thing for at least a decade, and then it was somebody from Ireland goes, "We trade euro," and the guy goes, "I thought you guys trade the pound." He goes, "No, we trade the euro." And when you get a guy who's been on, like an anchor that's been on CNBC and doesn't know the basics of this, it's like, this is the kind of educators and whatnot that they rely on. And that's also how they trade too, because cousin Johnny says, "Oh, this will be the next big hot stock." Because when you look at the performance of Bitcoin, nobody saw that, but I knew it was happening back last year in March, April, when it was $500-600. And then the bus drivers and the hairdressers know about, oh, yeah, there's this Bitcoin, and they're getting in on, let's say, October, November, where it's like 10, 15 grand. And then what happens in December? They get killed. It's the same kind of thing where Bitcoin's a classic example of that. They only will get in when their neighbor's getting it, and that's usually too late. You'll make a little bit of a profit, but if you don't get out fast enough, you'll get killed. And that usually happens, and it always comes back to timing and being able to look at that forward-looking data. And there's so many times I've had arguments with these guys over it, and they get killed. And that's the difference, I find. And it's those traders, the professional traders, the institutional guys know that. And that's the consistency I'm seeing. And that's what I want to build, not a typical trading platform that everybody else that you learn from. I don't want to name names, but you know what I'm saying, right?
Mm-hmm. Yep.
So
I disagree with you, but I know what you're saying.
Yeah. Well, a lot of people agree or disagree, but it all comes back to the same thing. Show me the money, right?
Exactly. And the people that make the money, they will not show you anything. So it's
well, yeah,
you can
you're
imagine that if in 12 years or more that I'm doing this, I met only 3 people that make money.
Yeah.
That you can go there. There are some scientific papers about the Hong Kong stock market. They did a survey, and they found 80 or around 80 to 85% of the people lose money.
Yeah.
And that is probably one of the only large-scale surveys that was done in a scientific fashion and not, sticking their finger in the air and looking which way the wind blows.
Yeah. I mean, to be honest, there's insiders, they call it Club 90-90-90, and I've talked about it for years, where it's 90% of retail traders get clobbered. 90% will lose 90% of their capital within 90 days. And when you factor it usually is the case. You know what I mean?
Probably.
Yeah.
But also you're talking about small amounts. I don't think that people who go into the market with larger sums, like tens of thousands of dollars, I don't think you will find that the attrition rate is so high amongst them. You will find that this 90 rule works in groups of people who spend $1,000, $2,000,
Yeah.
they lose it, they move on.
Yeah, that's right. Well, I put out a video a while back on how Forex brokers screw you. And one of the things they do is they
trade against you. That's not a secret.
Not just that, but there's the carry forward as well, where they know they're going to lose 30% of their clients the next month. That's why they market like crazy to replenish that pool. But where they make money is when you lose. Once you start winning, now they have to put up capital to go up against your trading positions. And that's where they do the market making. And if you're consistently winning, they're going to find ways to go against you. And it's not legitimate either. Like, I got a guy who just went through a court case with Oanda. And Oanda knew what they were doing was wrong. So he was he got kicked off out of the network and was no longer a client because he broke the terms of service or whatever. So he was no longer a customer. So he wanted his money back, plus he wanted a compensation. The head of the legal team said no, and apparently there was a lawsuit where Oanda went to federal court in the U.S. They lost I don't know if this is true or not, but it was an $85,000 settlement against Oanda. So you think if it's happened once, the court case was legit, and then you think, oh, well, they're not going to want to do this anymore, because if there's more court cases like this, the regulator is going to step in and close down, that broker like FXCM. So he hum and hawed it, and then he finally took it to federal court, and it was filed within a week. The same lawyer that said no came back and said, okay, we'll give you your money back, plus we'll give you another $1,000 as compensation.
But it's not a publicly known thing, because I had an account. I still have an account with the Oanda. I have 1 cent there.
I got $20 left.
So to me, with all the data that I gathered, Oanda was fairly reputable. There is a list of all the FX brokers, the big ones and smaller ones, and it looks at their capitalization. And Oanda was one of the highest rated, meaning if they had more reserve funds than what their clients had deposited.
Right. And when was this?
Easily 5 years.
Okay.
Easy.
Okay. I agree with you. And you're in Toronto. I'm in Toronto, and they did a meetup. They sponsored a meetup, and they did a little tour. And we went through the tour, and they showed us the market making, how it worked. And I'll tell you, I walked out and go, wow, this is legit. And when that Swiss National Bank fiasco came around, Oanda they came out unscathed because they had proper risk management in place. Everything was cool and legit. But when I joined Oanda about a year ago, I started learning that they had changed management, ownership. So now they're still operating out of Toronto, but now they're under, I believe, some kind of Asian Hong Kong consortium.
Well, the head office is in New York.
Okay.
And there is a branch in Toronto, or the other way around. But there are two branches that I know of.
Yeah, I know. But when, as far as I know, when it was founded in Toronto originally, and as far as I know now, lately in the last however long, they sold themselves to an Asian consortium, and that's where I think the problems started coming into play.
Yeah. Brian, I'm sorry, I have to leave. And
no problem.
I'm sure somebody else wants to talk, not just
well,
the two.
There's only three of us or something. That's
okay.
It? Yeah.
That's the big crowd. So, if you want, you can send me an email with your number and or send me an email and I'll send you my number.
Okay. You got my email?
I get your emails all the time about the meet,
just respond to that.
You're too far from me. I'm in Etobicoke and you're up in Newmarket, so.
Oh no, I'm not Newmarket. I'm North York.
Well, I call it Newmarket. You're north of the 401, right?
Yeah, but I don't know if you come down to my meetups at Young and Shepherd. I mean, we've had people come as far as Peterborough and London, Ontario for sometimes.
Well, but there are all kinds of delusional people. That's okay.
Yeah, but get in touch with me. Get in touch. Send me your email. Respond to that. feedback@quantlabs.net. And then.
Oh, you mean in the not in the Meetup website, but in the Quant Lab website?
Either one. Yeah.
Yeah. Okay. And
continue the conversation through that.
Yeah. Well, I just had an eye operation and I'm going for another one in about 10 days. So
sorry to hear that.
I'm not even looking at the screen.
Well, hey.
But hopefully in about a month, I'll have eagle eyes again.
Yeah.
And
well, hopefully I've got some better news on this type of strategy and more success.
I don't tie too much hope into this.
Well, let me say this. Forex is probably one of the hardest asset classes to build your chops in. From what I've seen with the ETFs and the equity, it's much easier. The returns
so why don't you do that? Now that you said that, give me one good reason that you are not doing that. Why do you concentrate so much effort on Forex when you know that it's almost a hopeless case?
Right, but I'm only the strategy is universal. It applies to any asset class. I do know that the rate of return is much higher with an ETF, like with an equity, without a doubt.
Why don't you do it on that one?
I do. But what I'm trying to do is to focus on the Forex. As I said, that is a hard asset class to master. If I can do that, any other asset class would be easy.
Brian, sorry, this makes no sense to me.
Yeah.
If you can succeed, or if your strategy works in ETFs and stocks, why on earth would you spend even 1 second on Forex just because you say, okay, it's hard, and if I can succeed there, I will succeed everywhere? You don't need to succeed everywhere. You need to succeed only in one thing.
Right.
And consistently, and you make your, I don't know what are your aspirations, but you're younger than I am, so obviously you can hope for more.
Yeah.
If I make $50,000 to $75,000 a year, I'm happy, and $50,000 is only $200 a day.
Yeah, that's right. Well,
right?
even look at it this way, from a portfolio optimization point of view. If you were to put X amount in and get a daily percent move, 1% move that you're willing to risk, and you got that each and every day for 240 days of the year, you will rapidly build up that account with the power of yeah.
Okay, but that will never happen, because if that would happen, then Bill Gates would be your driver.
Right.
So, and since he's not your driver, obviously this doesn't work. So I often wonder, why on earth would you spend, not just you, because other people do the same thing. If you would find a system that works on one stock, if that stock doesn't go out of business, you can milk it till the end of time.
That's right.
And if you agree with all this, then I still don't understand why on earth would you want to do something else just to prove a point. You don't have to prove a point. The point is that if you can make decent money in the other one and you park a Bentley in front of your house, then people know that you made it.
Right.
And you don't need to tell them, okay, I made it in Forex, because they don't give a damn. They see the Bentley and they don't care how you made it.
Yeah, that's right.
So to me, it looks like the people are looking at Forex for one reason. The entry bar is very low.
That's right. Yeah.
And the stories are extraordinary.
Yeah.
Like, they tell you that you can be a multi-gazillionaire in no time.
No,
Obviously,
that's not true.
nobody
Yeah.
is, or not too many.
That's right.
So, you know, I would hate to see you wake up 10 or 20 years from now and say, why did I waste all this time?
Right.
If you have a method that can bring you money now, then why waste the next 10 or 15 years to find out that actually it was a futile attempt?
No, all I'm saying though is that this is a strategy that's universal. All I'm seeing from what I'm testing, that the stock's equity has a higher rate of return, but it doesn't change the fact that it's still random. So for me to sit here and say 100% of the time I'll get X amount of dollars every day on a particular stock, we know that's not going to happen. But if you have
the 1% a day on Forex consistently will not happen either.
No, we know that. I know that.
So you cannot say, let's assume that I have a strategy that will make 1% a day. The moment you say it, you are not in the right direction.
Right.
No, my better half will kill me, but I'm risking my life for your sake now.
Sure.
There is a small quiz that I had many years ago, and I like the examples. I'll give it to you.
Sure.
You have
A blue marble and a green marble?
you have a 70% chance to make $300 in some kind of a game.
Yeah.
Or you have a 100% chance to make $200. Which game would you choose?
Obviously, number 2.
Okay. And if you have a 100% chance of losing $200 and a 70% chance to lose $300, which one would you choose?
Probably number 1.
Okay. In both cases, you're right. I don't know if it was a fluke or you understand why you're right.
No, I hope I understand. I hope I heard what you were saying. If what you're saying, I have a higher probability of making more capital consistently, obviously you go after that.
Okay, let's do it again. I think either you misunderstood me or I misunderstood you.
Yeah.
If you have a chance of 70% to make $300.
Yeah, let me get this down. Go ahead.
So you have 70% chance to make $300, or you have 100%, like it's a certainty that you're going to make $200. Which game will you play? Number one.
You go out, from my point of view, you take the 100% to make $200.
Okay, and if it's reversed, you have 100% chance of losing $200, or 70%, like less than 100% chance of losing $300. Which one will you choose?
Well, you take the one that gives you a lower probability of losing less money.
Which means?
You want to lower...
Is it the 100% 200 or 70% 300?
Yeah, I see what you're saying. I'd probably pick number 2.
Which is?
70% to lose $300.
Okay. Unfortunately,
yeah,
you're wrong in both cases.
Right.
And I'll tell you why.
Go ahead.
And when I was asked this question, I was wrong in one of them. So I was like 50-50. But statistically, 95% of the people give your answer.
Yeah.
Which is the wrong answer, and I'll tell you why. If you have a chance 70% chance to make $300, or 100% to make 200, you should take the 70% of 300, because 70% times 300 is 210.
Right.
So long run, you're going to make 210 as opposed to the guy who chose the 100% with $200. You're going to make $10 more than him. Now, the flip case, where you have 100% chance to lose 200 or 70% chance to lose 300, most people choose the 70% of the 300, which means they will lose 210 instead of taking a guaranteed loss of only 200.
Right.
So it's better to take the guaranteed loss of 200 than to gamble and lose 210.
Right.
Right? So in both cases, the answer is the opposite answer.
Right.
So since most people, and there are two guys, they won the prize, the Nobel Prize. There is something which is called the prospect theory, and this is linked to that.
Right.
And basically, the prospect theory is that people are like. Prospect theory, in essence, says that when people make money, they will close their positions fast, but when they lose they'll hang on.
That's right.
And they will be on hopium, not opium, but hopium.
Yeah. Yeah.
Now the thing is, they found that human beings are programmed to they don't want to suffer, and they want to enjoy the winning. So they will take a gain very quickly because that will make them feel good.
Right.
Yet they don't want to feel the pain of a loss. So by not selling a losing stock, they are delaying the pain.
Yeah.
And they are delaying it up to the point that they have to cut their arm off because they waited too long.
That's right.
So, well, there is one thing that you spoke about, but you didn't actually go deeper into it. Traders are ignoring the psychological aspect of training, and I ignored it for a very long time.
Yeah.
And if you ask somebody how much of trading is reliant on emotions, they will tell you a very small percentage, where in fact it's a very high percentage.
Right.
Very high percentage. You can have an excellent system. I can give you a system that guaranteed makes money, and you will lose money.
Yep.
They did an experiment with some professors and university students. They gave them a system that was rigged in such a way that they make money 60% of the time.
Right.
It was rigged like that.
Okay.
95% of the students lost money.
Right.
Because they were second guessing the system.
Right.
They should have bet constantly the same amount on every bet.
Yeah.
And because it's 60%, they would have made money. It's more than 50%, so they would have made money.
It's the same thing when it comes to risk management. A lot of people, let's say you want to make 100 grand or even 10 grand. I'm not going to do the math, but if you make 10 grand a year and you wanted to, you need to set a goal each day on how much profit you want to make. So let's say you work that daily profit.
Brian, no, because if you set a goal per day, and if you don't meet it, let's say you lose one day, then the next day you have to win double just to get back to zero.
Right, but where most people will get, well, I should say most, but some can consistently win. But what they do is they'll hang on to the winnings, and that's where their greed kicks in, and they usually will end up losing because they hung on too long. The point is, if you set some kind of daily target and you achieve that target, you shut down and you don't go back in the markets. Because if you make a target and you achieve the target, you get out for the day. And you do that every day. Most people will hang on to their winnings and hope they go from, let's say, 150 to 200 a day. They'll usually lose it, and they'll be lower than the target. And that's part of the problem where they, with the over trading, usually to get a 1% move is not very difficult. You'd be surprised by that, especially on the kind of tools that I've got. But once you get that daily profit that you want, you just stop and you get out and you start again the next day with the same methodology, and you make 150, 200 a day for the day, you stop and get out. Because, yeah, you may get 500, but then if you hang on, probability are you're going to lose not just the 500, but you'll lose the initial 150.
I don't know where you get this probability, because the probability, if you were winning up until now, then there's a good probability that you'll continue winning.
But that's where you got to stop.
No, but you don't know when your streak will end. That's the problem. You don't know that.
Yeah.
How do you know when your streak will end?
Well, I guess what I'm saying is once you hit your target level, you get out. You don't
But
hang on.
why? Who set that target level? Who said that that target level is a good level? Maybe you said that,
One of the
maybe.
best traders in the world that went to 9 digits in a very short time period.
Listen, anything that moves up too very high too quickly, yes, I agree with you. Get out as quickly as you can because it cannot continue. The problem is that how high is high?
Well,
If
it
you look
depends.
back at, sorry?
It depends. If you're a human trader, you'll let your greed kick in. But
No,
if you have
no.
go ahead.
You don't know. Like in 2000, I remember I have a friend. She didn't know anything about the stock market, but every time I spoke to her, oh, I just made 10%, I made 5%, 15%, and I was making absolutely nothing.
Yeah.
My money was in the business, so I couldn't care less about this. Eventually, she lost like 80% of her money.
Right.
So obviously, she didn't know when to stop.
Right.
And the people that were advising her did not know when to stop because had she stopped once she made 100% and the market went up to 400%, then she would look around and said, "Oh, I'm so stupid. I made only 100%. Everybody else made 400%."
Right. That's as a human that's using intuition.
Well,
But if it's a rules-based system, the system will shut itself down at 100%.
but you don't know if the rule is correct.
Yeah, but that's why if you have a methodology where you say I want to make 10 grand for the year, all you do is just say, okay, if I'm going to make 10 grand a day, divide it by 240, and that will give you your daily profit, what you need to get to achieve that.
It's not
Assuming,
realistic.
sure, it's unrealistic, but it gives you a much higher probability that you'll achieve it. I bet you right now, if you were to bet only the S&P 500 for the last year, out of all those days that those days were positive and profitable, let's say it's 80%. So you have an 80% chance of getting 1% move potentially per day. And if you have that target, you should be able to achieve it, I don't know, 2/3 of the time based upon S&P 500. I'm just guessing, but
If we would have spoken in March 2009,
yeah.
after the drop from October 2007 up till March 2009, there was nothing you would have told me that will justify putting even 1 cent in the market.
Yeah, but most professional traders saw that coming in 2007. That's my point. They knew what to look for. It's no different than what's happening now. You'll get the dumb brain guys going into the market now because they think that they're going to be able to continue trading. But if you look and you know what to look for, things like the market is going up, but when you look at the drivers of what is driving the market up, and it's showing signs of sputtering out, and you know that because that's what you're looking for, then you know you need to lower your risk. Or you look for other, let's say, regions that have a higher probability of getting a higher return, as in Asia. Maybe the markets in Asia have a better return. A lot of traders don't see it, or Joe traders don't see it that way. That's the problem.
Right.
They don't see the markets like that. There's always opportunity out there. Always.
It was nice talking to you.
Yeah, no problem, man.
We'll try and do this.
Yeah, you got my contact. Just send me yours, and we'll continue the conversation.
Very good. All the best to you.
Okay, thanks. Same with you, man.
Take care.
All right. Have a good night. Thanks for coming out. All right. Bye. Hello, everybody. We shall probably shut down. Anybody else got any questions on Facebook or the stream? Anything? If not, we'll shut her down. Hopefully, you've got something out of this. Anything? Okay, I'm going to do a going once, twice, 3 times, and if we don't, we'll shut her down. But thanks for coming out. I'll do a going once, going twice, going 3 times. All right, so next week, I'm working on a cryptocurrency trading outline. And if you have any areas you want to be not taught, but guidance, I can try my best to show you, let me know over the next few days as I'm building this proposal or outline, and then I'll showcase it next week, next Monday. All right, so hopefully you might come out for that. Let me know, And we shall talk to you soon. All right, I'll shut her all down. But thanks for coming on out. Have a good night.